Now, why were health savings accounts created? Well, first of all, the money you deposit into the account is not taxed. To be eligible to open an HSA, you must have a special type of health insurance called a high deductible plan. Tax treatment of health savings accounts. Hello, my name is Nick Young, and I'm an enrolled agent with Latino Tax Pro. We're an association dedicated to serving the needs of the Latino community through tax preparation training in both English and Spanish. Health savings accounts, or HSAs, are like personal savings accounts, but the money in them is used to pay for health care expenses. You, not your employer or insurance company, own and control the money in your HSA. Now, why were health savings accounts created? Well, first of all, the money you deposit into the account is not taxed. To be eligible to open an HSA, you must have a special type of health insurance called a high deductible plan. HSAs and high deductible health plans were created as a way to help control health care costs. The idea is that people will spend their health care dollars more wisely if they're using their own money. Like any healthcare option, HSAs have advantages and disadvantages. As you weigh your options, think about your budget and what health care you're likely to need in the next year. If you're generally healthy and want to save for future health care expenses, an HSA may be an attractive choice. Or if you're near retirement, an HSA may make sense because the money can be used to offset the costs of medical care after retirement. On the other hand, if you think you might need extensive medical care in the next year and would find it hard to meet a high deductible, an HSA might not be your best option. So what are some potential advantages of health savings accounts? Well, you decide how much money to set aside for healthcare costs. You control how your HSA money is spent. You can shop around for care based on quality and cost. Your employer may contribute to your HSA, but you own the account and the money is yours even if you change jobs. Any unused money at the end of the year rolls over, stays in your account to the next year, and is yours indefinitely. You don't pay taxes on money going into your HSA. Some HSAs pay interest on the unused money in your account or invest the money in mutual funds or other financial products. The earnings from an HSA are also tax-free. So what are the disadvantages? Well, illness can be unpredictable, making it hard to accurately budget for health care expenses. Information about the cost and quality of medical care can be difficult to find. Some people find it challenging to set aside money to put into their HSAs. People who are older and sicker may not be able to save as much as younger, healthier people. Pressure to save the money in your HSA might lead you to not seek medical care when you need it. And if you take money out of your HSA for non-medical expenses, you'll have to pay taxes on it. And that is inclusive of an additional 20% penalty tax. So what is a high deductible health plan? Well, as its name applies, it's a health insurance plan that has a high deductible. The amount of medical expenses you must pay each year before coverage kicks in. These types of plans are becoming increasingly common. Businesses are more likely to offer them as their only plans or as one of the limited options they provide. While the deductible is high with this type of plan, the premium, that's the regular fee you pay to obtain coverage, is typically lower than it is for traditional plans. High deductible plans don't start paying until after you've spent at least $1,350 for an individual or $2,700 for a family of your own money on healthcare expenses, although deductibles vary by plan. The maximum deductible is $6,750 for an individual or $13,500 for a family. So let's look at a scenario. Thomas has a high deductible health insurance plan. Now, he chose the maximum deductible of $6,750, which gave him a very nice low monthly premium. But if he has to use his full deductible due to an accident, let's look at how it affects him tax-wise. Here's how it would be on itemized deductions. The top part of the screen is for a Schedule A. As you can see, it would be less than 7.5% of his AGI and therefore would have no deductions. Now, this is assuming his income is $100,000, which 7.5% of that would be $7,500. He'd have to, and that's one way to look at it, if he even spent $7,501 in that tax year, he can only deduct $1. Now, with a health savings account, the $6,750 would be an adjustment to income, reducing his taxable income. If his tax rate is approximately 15%, he saved himself $1,013 in taxes. Sounds like quite a tax savings, doesn't it? Well, let's put this in perspective. Thomas has a high deductible plan, so he has to spend out of pocket more than $6,750 before the insurance starts paying. He does save on his taxes, but he still ends up out of pocket for the year $5,737. With the traditional plan, his deductible is $500. Now, he doesn't get any tax benefit, but his out-of-pocket money for the year is only $500. Now, I admit I'm not taking into consideration the amount of the monthly premium, which the traditional plan would be higher. I'm also not considering copays and the amount of coverage for each insurance plan. But even still, the out-of-pocket is way less, and we should all look at the overall out-of-pocket before deciding which is best for you. Before we go, what about California? Well, California does not conform to federal law, and this is from FTB publication 1001. So if an employer contributed money into an employee's HSA account, it would be added as taxable income on Form 540. If there were distributions not used for medical expenses, the amount taxable under federal law would not be taxable by California. Anymore, an HSA client receives a debit card that cannot be used anywhere other than for medical expenditures, so they can't have unqualified expenses like in the past. They either spend the money on medical expenses or they don't spend it. So thank you for your attendance and attention. We hope you found this presentation beneficial. If you want to see more topics in the future, be sure to like and subscribe. We'd love to have you visit our website at latinotaxpro.org or call us at the number shown on the screen. Until next time.